Good morning, ladies and gentlemen. Thank you for joining us for presenting our financial year results for the year ended 29 February 2020. Thank you very much for joining us on this very cold Johannesburg morning to hear what how productive we have been and where the company sees matters going forward, and I think we will obviously be going into quite a bit of detail. I will do the introduction as per normal. Shanil Maharaj will be addressing the financial section, and then Otis will be addressing the operational side, which includes the significant number of leasing that we've done and our capex plans and etc. And I will then be back to then sum up in terms of the summary, and we will then open the floor for questions. You will be able to email or type your questions that they will be read out, and we will read those out and we will answer each question as we go. Without further ado, I think it goes without saying that these are indeed pretty extraordinary times. Not only, from has South Africa gone down into a sovereign downgrade, but also in the midst of a COVID virus. I think certainly circumspection and conservatism is extremely required for companies to be sustainable. But we'll address all those as we go forward. As I go through the introduction on slide 4, I will touch on the assets under management. They have gone down by roughly R1 billion, and that effect has been we have seen a write-down on our property valuations of 744 million rand. Primarily affected by the rental revisions that we had communicated to market at the market pre-close, and those market revisions that we have seen are very much in line with what we expected as we concluded the significant number of leases that we had. Also affecting that particular number of 10.9 billion rands worth of assets is we did dispose of some grid shares, about 104 million rands worth of grid shares, and we took a further fair value write-down of 80 million rand as the grid share price was coming down. But we'll give more information on that as there's been some further announcements from grid, and we obviously plan to participate quite aggressively in that announcement as well. Our BEE scorecard, we've managed to retain our level 2 BEE rating, which is obviously important for us as we predominantly deal with government, and our rating is something that is quite key, certainly for myself and my fellow executives. On our exposure, that has ticked up quite slightly from our exposure to sovereign has ticked up slightly from 79% to 81%, and it really is marginal. That percentage has basically ticked up, and I think it's due mainly to one or two disposals that we have had success of, and obviously some vacancies as well in other sectors. On the NAV has come down pretty significantly, obviously affected by that 744 million rand that we have written off in terms of our fair value, in terms of the valuation of our properties. It goes without saying that going into year end, valuations was a major focus, particularly not only for management, for banks as well, and of late for auditors. And I think it's well documented that certainly our auditors have been very vocal about their stance to valuations, and I'm glad to say that I think we've had no issues with the auditors signing off on the valuations that we have, and I think that we've had robust look at the valuations. But Otis will go into more granular details in terms of the methodology that was followed around the valuation process. As a knock-on effect, obviously, our total value per property has come down slightly from the 109 million that we showed last year, the same reporting period, to about an average value per property of 103 million. As a result of that write-down of the 744 million rands in the property valuations, predominantly affected, as I've already mentioned, by the rent revisions that we've seen. As I flip over to page 5, I think we have been reporting increasingly challenging business conditions. It's been very, very tough, both for management and shareholders. Since 2016, we've been in long, protracted negotiations with our biggest customer, being DPW, on the bulk leases. I'm glad to say that we have made significant progress in that regard. And I will obviously give more details, and certainly Otis will give a lot more details around the progress that we've made on the bulk leases. But our business is not only just about DPW national. We've got provincial clients, government tenants. We've got state-owned enterprises equally who need to be serviced and managed. And I think we've done a significant amount of work, not only at national level, also provincially, to make sure that we've been able to achieve the record number of leases that we have achieved in this period. On the leasing side, as I've already mentioned, we managed to complete 211,000 square meters of GLA, made up of 112,000 square meters of GLA from our bulk lease renewals, with 3 remaining leases that are critical for us, totaling some 83,000 square meters there, for us to really consider probably that bulk lease renewal negotiation concluded. We had received proposals on 2 of the 3 leases remaining. The price that is currently on the table, we feel that is a bit shy of our target, and I think we have responded back to DPW with a counter, and we will make an announcement at the conclusion of those 3 leases once that has been concluded. On the balance of the roughly 99,000 square meters of other leases that we have concluded, I think we have done relatively well. We've also signed 17,000 square meters of new leases that we did not have in our portfolio in a very tough economic environment, where it is actually a tenant's market, where there's a lot of office space available. Our tenant retention has been roughly around about 90%, which is phenomenal given the tough economic environment that is that we're currently trading under, and it's something that we do need to take cognizance as we go forward. We have seen a slight uptick in our WALE, which we've been trying to telegram to the market. Our WALE had obviously been greatly affected as we were involved in these protracted lease negotiations, and our WALE currently now sits at 1.6 years, and we are quite certain that once we conclude the 3 remaining leases, we should see, and plus other provincial leases that we're working on, we should see that WALE sit between 2 to 3 years, which obviously has an impact from Chanel's perspective in terms of the funding terms that we see from our banking partners, and also terming out further progress on the funding side that we have. The bedrock of this entire business is definitely the leasing, and I think we definitely feel as a management team and as a board that we've made significant progress, and we are starting to see some green shoots, certainly on the funding side that we will take you through. We've committed some facilities, and we'll give you more details shortly. I turn over to page 6. I think capital recycling in this current environment is quite critical. Delta has obviously disposed, as I've already briefly mentioned. We've managed to dispose about 2.1% of our shareholding in Grit for a consideration of 104 million rand. We have telegrammed to the market well in advance that our shareholding in Grit is not strategic. We do need the capital resources to obviously use at bringing down our LTV and managing that quite vigorously, and we have done that I think successfully. We do aim to participate quite aggressively, and we have already started engagements with Grit based on their latest SENS announcement that was made on Thursday or Friday last week about potentially repurchasing 7 million shares, and we definitely want to make sure that we are appropriately positioned to make sure that we can basically further dispose and participate in that disposal program and repurchase of shares by Grit. So, and I think we will then, as those negotiations continue, we will be able to give more information back to the market and shareholders as we conclude on that environment. I did make mention on debt earlier. I think we have mentioned that we have made some progress. We have managed to refinance on a medium-term basis about 3.8 billion rands worth of debt that was expiring with Nedbank, and the reason why it's on a medium-term basis is that we have an agreement with Nedbank that, once the 3 remaining large leases that are outstanding, it is our joint intention that we will then put a permanent facility in place, which we have some great support from Nedbank. With regards to our facilities with Investec, we have broken the portfolio with Investec into 2 parts, the A tranche and the B tranche. The A tranche is made up of leases, is made up of buildings that have confirmed leases that form part of the 211,000 square meters that I've already mentioned. That tranche has been reconfirmed and signed for 3 years, and the remainder, which we are still working on, which is tranche B, has been extended for 12 months. You can already see that our banking partners are already starting to see the confidence and the results of the hard work that this management team has been putting in place, whereby historically we've only been getting 3 months extensions. We are now starting to see 12 months, and as I've already mentioned with Investec, on tranche A, we've got a 3-year extension. A 3-year facility in place, not an extension, a full facility. And we expect to see the same once we conclude our discussions with Nedbank. And I think and those discussions have been robust, and I think they've been very, very fair. And I think we've seen our cost of debt come down slightly as well as a result of that. But I think as an incentive to try and make sure that we conclude the balance of that. If I go over to the next paragraph there on capital allocation, it goes without saying. I think we've always communicated that Delta's strategy has been always to commit, to get government to commit on leases before we roll out a major capex program. Because, what we've seen from historical is that it takes anywhere between 18 months to a year to renegotiate a government lease. And we now have signed leases. We've got certified commitments of circa 200 million commitment on the leases that we have signed. And we want to try and term that out over the next 3 years. And we will continue to update the market in terms of, as we sign more leases, what our obligations, contractual obligations with government are. It goes without saying that, I think, given these commitments, that obviously has an impact in terms of how the company wants to retain cash, which is very, very important to be able to fund this capex. And I think given the current environment, capital is very, very scarce, and I think the company needs to be prudent in terms of how we deploy our capital to make sure that we get best value for money for the capex that we spend, and we see the results going forward. As far as COVID-19, which has affected all of us, I think we have managed to keep the business very much afloat. We did give a SENS announcement just as a tacit update to the market that we had at that particular stage collected for both April and May about 70% of our collections. I'm happy to say that as of last week, we had collected above 80% for both April rentals and May rentals, with the balance of 10% to be collected once government is fully operational. We do have some concerns around some of our tenants, particularly around RECON. I think it's well documented that RECON has entered business rescue. Our exposure to RECON is 5,900 square meters, and we are obviously putting plans in place to make sure that we minimize the shortfall, the downside risk, if should RECON Group not be able to make it out of business rescue. On the balance, we've received applications for only 10% of our retail tenants that have requested assistance, and we have a very detailed, transparent negotiation with those particular tenants to try and help them out, which only constitutes 10% of our retail tenants. Obviously, of concern is we discovered this weekend that there has been, unfortunately, a new strain of coronavirus that has broken out in China over the weekend, and Beijing has come into lockdown, which obviously may lead to more conservatism around the globe as the second wave of coronavirus spreads around the globe. And certainly we see that South Africa may very well be also affected. So, coronavirus and the effects thereof may be with us for some time. And I think funds that and companies that take a conservative approach, I think, are companies that definitely will be around to make sure that they've got enough cash reserves to basically go through the tough times. I think, in our humble opinion, so far, based on the sovereign performance and the collections that we've seen, our sovereign tenants have been very much in line with normal collections, as I've already mentioned, and this should be pretty resistant towards any shocks that the market may have. Unfortunately, all the financial models or financial projections that people have did not see coronavirus coming up, and I think we all need to be circumspect in terms of what the long-term effects of coronavirus will be on companies, unemployment, and obviously tenant retention will be quite key going forward. At this point, I would like to hand over to Shanil. I will be back to discuss about the summary and give further input around our vacancy strategies and other strategic initiatives that we've basically taken place.
Thank you, Sandile, and a very warm welcome to all of our stakeholders this morning. No doubt a fairly chilly morning throughout the country. And I think from a financial perspective, just to follow through from Sandile's introduction, Delta, it has been obviously quite a challenging year, as no doubt with most other counters in our space, particularly the property listed sector. But I'm happy to announce that I do believe from a Delta perspective we have managed to come out strong. You know, there's still quite a bit that needs to be done in the business, but from a financial perspective, I think the levers are moving in the right direction. And if you just take into account the performance that I'm going to highlight to you from slide 9, you know, I think our first biggest focus in the business is the LTV. LTV is a critical measure for us in respect of the covenants that we have with the banks. During this financial year, it has creeped up slightly, and I think, as Sandile has mentioned, you know, one of the major contributors is the valuation of our investment property, our property assets. What has led to that specifically is obviously the increased vacancies that we've had in the portfolio, together with the reversions on the lease renewals. I think where we take some comfort is that if you look at the reversions, we've managed to stem that and have that within guidance that we've given to the market in the past. The vacancy is obviously something that we hadn't planned on, and that has impacted. So that translates into quite a significant negative valuation on the property assets. Combined with that is obviously our initiative, our long-term strategy, as we have been communicating to the market, to dispose of our investment in grit and create some liquidity in the business. With that in mind, we were successful on disposing around just over 2%, which effectively freed up about 104 million rand worth of liquidity in the business. That free cash flow was utilized to settle debt and de-gear the balance sheet. From a debt perspective, you would see that our cash position has increased significantly in relation to the prior year. We're looking at about an increase of about 100 odd million rand. In addition to that, our borrowings have declined about 230 odd million rand. And as you would read through our results announcement, you will see that one of the factors is that we are amortizing facilities with the banks. And for the financial year 2020, we've settled just under 130 odd million rand. So it does have a cash impact, but also has the ability to reduce our exposure to the banks. Regarding our facilities, you would recall we had about 3.8 billion rand worth of debt expiring for the 2020 financial year. And as Sandile has reported, we've managed to extend all of that debt. And we would have preferred, obviously, to have a longer-term refi done on those facilities. However, I think together with our banking partners, we do have a soft arrangement in that the lease progression is fairly critical. And as we progress on the lease, you would have noted our WALE increased from 1.2 to 1.6, and we're expecting further progression on the WALE. That's obviously going to help us quite significantly in respect of negotiating longer dated facilities with the banks, and obviously terming out the debt expiry profile, which no doubt is quite a concern for most of our shareholders. From a fixed debt perspective, that obviously has been ticking down, partly the passage of time. And if you look at the 45%, it's not in line with our medium to long-term strategy and objective. I think as we have been communicating to the market, you know, we would like to have at least between 70 to 80% of our debt hedged. And obviously taking into account the current economic environment and where rates are, we're using that opportunity to engage with the banks, obviously subject to credit lines being available, to put in place more hedging instruments, particularly the interest rate swaps. So we're hoping to make some further progress in that regard. There is anticipation of a further rate cut at the next MPC meeting. So from a banking perspective, we do believe quite a bit of the risk has been priced in already, and we're hoping within the next month to execute further interest rate swaps that will improve that fixed debt ratio. Debtors, our debtors days as well has ticked up. I think it's still well managed. You know, our target is 30 days. We're sitting at 33 days. There are a few tenants that we have arrears with, and our property management teams continue to engage with them. We do have a task team in place. So we're keeping that engagement fairly intimate to make sure that we get quicker progression out of that. So our property management team are incentivized via the property management fees to ensure that the collections are robust in the portfolio as well. The property operating margin has declined, and that's obviously correlated to the cost to income ratio in the business. As mentioned earlier on, you've had the reversions and the vacancies that have impacted revenue. So from that perspective, you've lost just under 100 million rand worth of revenue. Loss of such revenue does not always guarantee that you would have a proportionate reduction in costs. There are fixed costs. If you look at the nature of our buildings, we've got single-tenanted buildings, but also multi-tenanted buildings. So obviously the vacancies within the multi-tenanted buildings do not give you a lot of the benefit with a proportionate reduction in fixed costs. And that's one of the reasons why, if you look at our margins, they've actually come down slightly. Interest cover, another critical matrix for us in the business, and that's obviously due to the fact that it's a covenant linked to the debt facilities that we've got with the banks. We have engaged with the respective banks. They are fairly familiar with where the cover sits. Our covenant is at 2. We're sitting at 1.9. Still not significantly below, but it is below nevertheless. We have got letters of condonements from our banks, because obviously the long-term prognosis is that we will normalize the interest cover ratio. And this again is on the back of putting together longer dated facilities, reducing the rates that we currently have with the banks, so getting more competitive pricing. All of this works in collaboration to improve on that interest cover ratio. And we are hoping that we are able to normalize on that interest cover ratio. If I just go across to slide 10, and this is just giving you a complexion and a graphical, a tabular representation of our 5-year review. Again, just to take you from the top, if you look at the revenue line, we're down about 90 million rand. And if you look at that 90 million, almost just under 4% is as a result of the reversions. The reversions that we have incurred in this financial year, I think we've done well. The forward-looking prognosis could be a little bit worse off than this 4%. And if stakeholders do recall, we have been guiding the market that when the whole process is concluded, we estimate our reversions to be in the range of anything between 6.5% to 2%. And again, that's based on the engagements and how we actually managed to conclude on these lease rates on renewal. So that's a bit of a moving target for us as well. But reversions has impacted us by about 3.6 odd percent versus the prior year. Vacancies is a lot larger at just over 4%. So that's obviously had the major effect in our revenues coming down. From our net property perspective, it's almost the reversions and the vacancy impact on revenue that has trickled all the way down. So you will see they're almost aligned. Finance costs has increased marginally, impacted quite significantly by fees. And I think that's one of the challenges that you have with extensions, is that you have multiple extensions during a financial year, and each extension comes with an obligation of a facility fee. So those fees have a negative impact, and we're very cognizant around those fees, and that's one of the reasons we also need to term out our debt expiry profile. I've touched on the cost to income ratio and the reason that has moved. The vacancies do have an impact on these cost to income ratios. So I guess the strategy for us is obviously to grow the top line, the revenue line. By growing the revenue line, we obviously start reducing our cost to income ratio. So that's where the strategy lies. Investment property, we've discussed the valuations purely, just over 740 odd million, which was quite significant. And obviously, as Sandile mentioned, it was a very robust process that involved the valuers, involved the auditors. There was a very detailed methodology that Otis will give you a bit more color around. So with that being said, the number was quite hard, but effectively we've taken the knock, and the intention is obviously to grow further from here once we have further longer dated leases that materialize in the portfolio. Sandile has spoken quite extensively on grid, so I'm not going to spend too much of time. Just to highlight that our strategy is to dispose and obviously realize that to create some liquidity in the business and deleverage the balance sheet. I've touched on the borrowings. We've reduced that by about 200 million. Again, the capital repayment was quite a significant part, together with the 104 million rand cash that we freed up from the grid disposal. I think I've covered most of the points, and then, maybe just the last focus on this slide is on the NAV. There again, the NAV was obviously quite significantly impacted by the valuation, and that's going to be quite a talking point for us as well, and a significant objective going forward. If I take you to the next slide, slide 11, this just demonstrates to you, to our stakeholders, the methodology and the calculation behind distributable earnings. To take you through the page, you will see the loss attributable to owners of the parent is quite a significant loss, the 588 odd million, but that's primarily because of the 700 odd million rand that's related to our investment property assets. Take further down the page, if you look at the distributable earnings attributable to the owners of the parent, 326 million versus the 499 in the prior year. Just to give you a very high level reconciliation, our net property income was down by just under 100 million rand. In addition to that, and this speaks to the fact that we have retained a level of income which then makes it taxable. So between the net property income of just under 100 million rand coming down and the tax of about 75 odd million rand, that's effectively the high level reconciliation of the current year to the prior year. What we've done this year, so the 326 and the 499 is effectively done in terms of the REIT's best practice. That's the REIT's calculation of distributable earnings. We've decided this year to give shareholders a bit more complexion, because historically, whenever there was an element withheld, the assumption was that cash withheld is an actual cash flow to the business. And I think that is why this year we've decided to include the capital expenditure and the capital repayment. So these are all obligation on cash that doesn't come through your income statement. And if you just look at those numbers that we've quoted there, 23 million on capital expenditure, 129.8 million rand on capital repayment, I think stakeholders will get a lot better color as to how the cash flow is being applied. Because if you take the 326 and then you remove the effect of the capital repayments that doesn't come via the income statement, that leaves you with earnings that's theoretically available for distribution of about 173.6 million. And that obviously changes the picture quite significantly. If I just refer you to the next slide, slide 12, you would see from a delta perspective, we did declare the 12.2 cents at interim, August 19. That translates into a quantum of 87 million rand. So if you take the 173 on the previous page, less the 87 million that we have distributed to shareholders, that leaves us behind with about 86.5 million rand in cash. So for our stakeholders that are very close to the business, you would realize, and as Sandile has mentioned, we've got quite a significant capex pipeline. And at this stage, there isn't any headroom from a facility perspective. And that capex is contractual. So that comes on the back of the leases that have been signed. So taking all of this into consolidation, it is quite a stretch for us in the next financial year. And I think from our perspective, to be very prudent and responsible, we've had to retain cash to support these initiatives. And I guess, all of the investment that we put into the business at this stage obviously will reward shareholders further down the line. So we're hoping that our stakeholders understand the stance and the value creation for the business that will take place further down the line once leases have been signed and the capex has been invested in the portfolio. If I just refer you to slide 13, that's just a graphical representation that takes you through the historical distributions declared. Obviously, it's a little bit of a sad graph. If you look at what has been distributed in the financial year that has gone by. However, we are fairly confident once the business is back up, once the health of the balance sheet has been restored and the fundamentals of the business are restored, the historical graphical representation will continue into the future. On slide 14, that's just a distributable earnings bridge. Here again, it's a graphical representation of our earnings from the prior year versus how we've come to the earnings in the current year. And I think the bridge really gives you a very good representation of the factors and their respective impact on earnings. So if you just look at the graph, you would see tax has had quite a significant impact at 75.4 odd million rand. Next to that has been the vacancies, 68.4. Net property income of about 54 million rand reduction, that's linked to reversions. Finance costs, as I mentioned, fees have had a significant impact, together with the marginal increase in some of the facility rates. So that's the 23.8 million. Another aspect to mention is that if you look at our provisions in the business, and I think stakeholders will be very fair with this, if you look at IFRS, you've got the likes of IFRS 9 and of late IFRS 16. These are all related to expected credit loss provision. And this talks to the fact that IFRS would like you to consider impairments not when an event takes place, but rather pre the event. So with that being said, we've had quite a bit of provisioning that we've had to take on our loans receivables, on our trade receivables as well, to a lesser extent. There have been some specific provisions that we've put through the business. Notably, we've had some adjustment accounts that have been outstanding for an extended period. And the debtor of those adjustment accounts have been put into business rescue. So from a company perspective, we've obviously had to take the prudent approach. That was about 12.8 million rand. So overall, the provisioning in the business has had an impact on earnings as well. If we move on to the next slide, slide 15, that gives you a like-for-like analysis of the portfolio. And there again, if you just go to the bottom, you will see that the like-for-like net property income has declined 8.5%. And that has obviously been an impact of all the factors, reversions, vacancies specifically, disposals included. We did have a reduction in income of about just over 18 million rand, specifically around 2 buildings that we did dispose of during the Feb 2020 financial year. So 8.5% has been the decline on a like-for-like basis on our net property income. If we just move on to slide, here again, this is just giving you a summarized complexion of the statement of financial position. I think I've covered most of the explanations earlier on in my slides. Nothing specific to mention. And you will see, again, it's just, for us, the focus is around the debt. Current liabilities, 4 billion rand worth of debt under current, meaning that's what we're having to work on in the next financial year. And I'm happy to announce, as Sandile has alluded, we've made some significant headroom with our funders, particularly the likes of Nedbank, Investec, and Standard Bank. And, I do envisage that our bankers are on the call. I think we'd like to really thank you for partnering with us on this journey. And obviously, forward-looking in the business, I'm going to touch on that a little bit later on. I do have a debt funding slide that I will give you a more complexion as to where we are with the 4 billion. Slide 17, again, is just a NAV bridge. Again, that just takes you to the movement in NAV and really gives you the complexion of what has really moved the NAV. Again, and sounding like a broken record, as you would see, the fair valuation, the negative fair value adjustment on the properties have had a significant impact on the business, and it's on more than just one facet. Your LTVs, your NAV, also, with regards to some of the covenants that we're very cognizant around. So this slide, again, to avoid repetition, I think it gives you a very good sense as to how the NAV has progressed downwards. If we just move to slide 18, this again is just a very high-level summary, debt summary of the business. This shows you the amount of floating facilities that we have. Unfortunately, our fixed facilities, due to the various extensions that we've engaged or initiated and concluded on, a lot of the fixed facilities have fallen away. They've become floating. So there again, you would see in respect of the swaps that we've got in the business, we've got 2 billion rand worth of swaps. We obviously would like to almost double that if possible, credit lines permitting, and get that fixed number up. Slide 19, just around the debt commentary. There again, you would see it speaks to what I've touched on earlier on. You know, we've had about 153.5 million from non-core assets. And I think just to highlight, when we say non-core assets, it's a combination of property assets and our investment in grid. So that 153.5 is in essence the 104 million we're speaking of regarding grid. There was a further 2 properties that's just over 49 odd million, and that gives you the 153.5 million. The amortization of 130 million rand, quite significant, very pressurizing on the cash flow, as you would no doubt infer, and we continue to engage with our funders. You know, the amort as well is a temporary measure. It speaks to the vacancies that have crept up in the portfolio and with some of the shorter dated facilities. So we are hoping that once we bring the vacancy levels down, we move the whale up in the right direction, we should be able to negotiate out the amortization from these facilities. With regards to the 4 billion rand that I mentioned earlier on, from an Investec perspective, and Sandile has touched on that as well, you know, I think they've been very innovative. They've actually understood our portfolio. They've put them into a portfolio A and B. And again, by segregating the portfolio, it's more to give us some time and the ability to work on the shorter dated leases and the higher vacancy portfolio that we do have. So with that being said, you know, we have on portfolio B, which is the longer dated facility, it's a 3-year facility. So for us, that's quite a big win. I mean, we haven't had that over the last 2 to 3 years in the business. So again, it speaks to the fact that the fundamentals are ticking in the right direction, and we hope to continue on the same basis. Nedbank, again, our major funding partner, you know, 2.3 billion rand of the 4 billion, which is quite a substantial number, has given us the ability to extend for a 3-month period. And there again, the extension was purely to allow us the benefit to conclude on the major remaining leases. You know, if we had to go in now and try and restructure longer term facilities, as you would imagine, the rates are going to be penal. So with the remaining leases having materialized and the whale pushing out, we will be in a lot stronger position to be able to negotiate, especially on the term of the facility, together with the funding costs. Standard Bank alike have given us we're currently in negotiations with Standard Bank. They have given us a very high level profile of what they are proposing. There's a few CPs that we just need to finalize and formalize with them, and we're confident to have that as well initiated within this month, in June. If I just take you over to the last slide that I have, which is slide 20. You know, and here again, I think it's just repeating what I've been saying throughout the document, is that our objective financially is we need to term out this debt expiry profile of the business. We need to put in place longer dated facilities at market-related rates. Our covenants are critical. You know, we need to ensure we have a covenant with the banks on LTV of 50%, ICR of 2. So our ICR hasn't deteriorated that significantly. However, nevertheless, that's going to be a very, very key objective for us in the financial year ahead. From an LTV perspective, I think I've given you sufficient color around that. I think for us, again, to re-emphasize the objective in the next financial year is to obviously sign those leases, reduce those vacancies, and hopefully that should translate into further value creation for us on the property. You know, Sandile has mentioned COVID-19. I think our business has been fairly resilient. We have collected over 80%. We are hoping to collect a further 10% from some of the provincial tenants that have obviously been occupied with COVID-19 initiatives. The balance of the 10%, retail and non-government, does remain a concern for us. However, the quantum in respect of the business is not significant, but any loss of income has an impact on cash flows in the business. So we are very mindful of that. And we continue to engage with those retail and non-government tenants in a very responsible manner. You know, again, it's not a matter of a tenant coming up to us and saying, listen, sorry, I can't pay you, because there are a lot of tenants that are taking you know, I wouldn't want to say, they're making use of the whole rhetoric in the system around COVID-19. So we follow a very diligent process that involves interrogating management accounts, looking at bank statements, and with that in mind, we obviously start with what we classify the good tenants first, and hopefully we are able to come through that. With that being said, thank you on the financial review, and I hand you over to Otis for the operational review.
Good morning. Thank you, Chanel. Good morning and welcome to everybody. I'm here to take you through the operational aspect of the business. I will be spending a lot of my time on slide number 22 and focusing predominantly on the leases, but will touch on all the other operational aspects of the business. I think on page 22, our 77% of GLA, close to the 80% that Sandile alluded to earlier by income, has really stood us in good stead. I think we're seeing a situation where the rest of the property sector is taking a big knock from the COVID challenge. With us having 80% coming from national government and sovereign, we have not had any challenges to date from any of our sovereign tenants regarding any rent relief or anything like that. The 10% that we've had is been from the mums and the pups in the retail centers that we have downstairs of our buildings, and a few small tenants. We have had some retail tenants called the retail group, the likes of Mr. Price, your Pepcos, who've obviously grouped themselves into a grouping that is dealing with the landlords under the guise of the property industry group, and we're dealing with those ones in that manner. But I'm happy to say they make a small portion of our portfolio. So what we've done as well, as Shanil and Sandile alluded to, is that on our collections, being a government fund is actually standing us in good stead. We have collected 80% of our rentals in April as well as in May, and we are hoping that it remains that way with level 3 lockdown. The next thing I want to talk about is our renewals. I think on our bulk renewals, we started off with 227,000 square meters at national government. That was made up of 58 lease agreements. I'm happy to say we've done over 50%. We've done 112,000 of the 227. Of the remaining 128, we have 3 big leases, of which 2 are in buildings in Pretoria. We'll share that detail on the one-on-ones. We didn't want to put it into our results here, but it's tenants that we are quite well advanced in for the 83,000 square meters. We have dealt with both DPW and the user departments, and we're looking at 5-year leases on those 3 lease agreements, all in Pretoria. When we renew those 3 leases, our WALE will increase from the 1.6 to well over 2 years, close to 3 years on that. We then have the balance of the lease is about 30,000 square meters, which is made up of what we term the default leases. We have shared with the investment market that those are leases where DPW is signing a once-off 3-year lease term. The only drawback with the lease is that it has a exit clause that allows them to give you 3-month notice, and we've been negotiating with the tenants and DPW to get that clause removed. One of the things that we are using to push back is that the rentals on the default lease are quite high, so they're really costing fiscus a lot of money. And then we are also saying that with the default lease, having a 3-month clause will not be putting any TI, and that is getting the attention of the user departments who are joining us in pushing that we waive the 3-month exit clause. And then the next box on page 22 is a 211,000 square meters that we are quite chuffed about. I think in the 8 years that Delta has been listed, that is a record that Delta has done. Of that 212, the 112 is obviously coming from the DPW, the bulk lease, and then the other 100,000 or just below 100,000 shows the amount of work that the team has been putting in all the other facets of our business. We have some municipal leases in there that have been renewed, leases like Shell House in Durban, We've signed a 3-year lease for 14,000 square meters. We have some state-owned enterprises. SARS in Belleville, we're happy to say we've signed up 16,000 square meters on a 5-year lease, which we're really, really chuffed about. And then provincially, we've also been seeing some traction. Mayor's Walk in Pietermaritzburg, we signed up 5,000 square meters on a 5-year term at 120 rand a square meter, 7.5% escalation. So that shows that the team has really been putting some significant effort on our leasing, which will obviously translate to an increased WALE. If I jump below on the WALE, you can actually see that our WALE had been going down since listing. I mean, we started off in 2012 with a WALE of 7 years in the good old days when we qualified for the 10-year leases. The WALE has been going down as a result of the delays at DPW in renewing the leases, but we're happy to say it's now, we've turned the tide, and it's reflected. I mean, Feb 19, we had a WALE of 1.2. The WALE has gone up to 1.6, and when we do conclude the 3 big leases, we'll see that WALE going up to 2 years, in excess of 2 years, where we can then start having meaningful discussions with our bankers. If you look at the 112 that we've renewed of the National Public Works, the bulk of that, I think well over 60%, is over 5-year terms, and the other ones are on 3-year terms. So we really think that our WALE will start going up going forward. On the new leasing front, we have done, I think when we reported in Feb 19, we've done about 6,000 square meters. We've more than tripled that to just under 18,000 of new leases. The new leases are made up of predominantly SARS in Randburg. You recall they gave up some of the space a year and a half ago. They've managed to take up another 3,000 square meters on a 3-year term. So that is one of the new leases that we've got. And then in Durban, we've got the SIU. We've taken up another 2,500 square meters. I'm happy to say also post-reporting, we had lost a tenant in Pietermaritzburg, Capital Towers. That building has been vacant for just under a year. The Department of Health provincially moved out, and we had a 13,500 square meter void in Pietermaritzburg. But through very hard work, we've managed to successfully relet that entire building to 3 provincial departments that we've actually poached from other landlords in the node, which we think is a feather in our cap. It came post our Feb 2020, and it's another 10,500 square meters that's been taken up. We also had in Pretoria, had advanced negotiations for Delta House, which is a 10,000 square meter building in Pretoria. We were talking to one of the education groups, a listed entity, if I may add. Post-COVID, we had really buttoned down the deal. They had entered into a 10-year lease with an option to acquire the building, but COVID has affected them, and they've obviously asked that they would like to review the situation post-COVID. And we remain hopeful that, given that it's a building that they need in the node, that we may be able to get conclusion on that matter. The one downside is obviously our vacancies have shot up. The Capital Towers building that I spoke about, I think at Feb 19 we had a vacancies of around 14.4. Our vacancies sadly shot up to about 21%, driven in the main by Capital Towers in Pietermaritzburg. But as I reported, we subsequently managed to re-tenant that entire building. And the tenants actually took occupation beginning of May. We managed to work, I think as a government service, we were deemed essential. So we could do some work to get them in. And they've moved into the building, which has seen the reduction from the 21% to just under 19% in our vacancies. We do have some disposals which are quite advanced, like Protea Coin, where when that building, which is 5,700 square meters, transfers, it will bring down our vacancies. And then we also have 1 or 2 other buildings that have vacancies that are quite advanced, which will see a reduction in our vacancies coming down. If I can please take you to slide 24. On that slide, I just wanted to touch on Office Sovereign, the column, just to show that where we've stuck to our knitting, as it were, where we've stuck to inner city buildings, our vacancies are more or less in line with SAPOA. You will see there, of the 567 square meter GLA, we only have a vacancy of 15%, and with the activity that we are doing, that vacancy should go down. On office other, that covers the 34% is really the node where we had ESCOM in Sunning Hill, and that is reflective. Sunning Hill is a node that we are making traction. The tenant that we had, the medical aid Universal, have indicated that they're looking for additional space, which should see the vacancies in Sunning Hill start to come down. Also included in there is our problem node, which is obviously the Free State, in that 34%. Unfortunately, in the Free State, we continue bleeding. Part of the reason why our vacancies have gone up is that we've lost one or two tenants in the Free State, and we are actively trying to dispose of our assets, the provincial ones, as it were, in the Free State. The industrial vacancies show a big number of 82%, but I'm happy to say that that is only made up of two non-core buildings, being the Protea Coin buildings, of which the Protea Coin Cape Town should transfer any time in the next couple of weeks, which will see those vacancies going down. And then obviously aligned to the vacancies in the cost-to-income ratios under office other, the number shows a high number of 47.6%, but that is a reflection of obviously the vacant nature of that portfolio. I'm going to jump to slide 26, where just a repetition of the leasing activity that we've done, the 212,000, repeating that we've done the 112 at national government level, with the bulk of that being predominantly over 5 years. 60% of our bulk renewals are for 5-year periods and above that. And then again, we touch on the 83,000 square meters, which we are bullish that by interim we will have concluded. We believe we will have concluded earlier. The COVID lockdown obviously caused delays. The people that we deal with at the national level are the senior people, and they had been co-opted into provincial task teams to deal with COVID. But given that the users are in the buildings, I mean, one of the buildings is correctional. It's a national command center for correctional services in the country. They have spent a lot of their own money in the building, and we know that they will be renewing that lease agreement. Our arrears, as Shanil alluded to earlier, have ticked up slightly from the 31 days, debtor days, to just under 33, but it's still manageable. We have a DPW task team that works closely with the department in trying to continue getting those arrears down. Our disposals remain challenging. I think we've only managed to move a small number of disposals. We sold Top Trailers in Wadeville, which is an industrial building, for 45 million. We sold a small building in Free State, Classic Corner, for 5 million rand within book value. And then a broadcast house in Mutata, a building in Mutata where we were struggling to get a long-term lease. We've managed to sell that, and that transferred post the reporting period. The valuations, again, was alluded to earlier. We've seen a decline in the valuations. I think there's a lot of focus on valuations, and we sat down and worked with our valuers. We used the income capitalization method and the discounted cash flows. Where the buildings had voids and empty vacancies, those were taken into account. Where the market rentals are above market, they top sliced and brought them down in line with market, and that has culminated in us losing close to $750 million in our valuations. The average cap rate on the portfolio has worked out to ranged between 8.25% to 14% on the cap rate, and in terms of the discount rate, we're looking at 12.75% to close to 18%. I think on the next slide, 28, we touch on our CAPEX program. I think with the advent of COVID, there's a lot of emphasis on employee well-being. We do have safety and health in our budget. I think the market will recall we've always spoken of an average spend of close to 200 million. With the lease renewals, there's additional 80 million rand, or just under 80 million rand, for tenant installation, which is obviously lease related. The way we deal with our lease renewals, we we give 1 month rental for every 1 year of lease, and that is included in our budgets. We have started on our capex and on the buildings where we've actually renewed the lease agreements. Again, just to touch on COVID, I think there's less than 10% of our income, or 9%, which is under risk. Being a sovereign fund has really stood us in good stead. We continue getting rentals from DPW, from the state-owned enterprises, and the provincial government departments. We've not had any approaches for any rent relief of any sort. The ones that we're dealing with is the one that we're dealing with via the PIG, the Property Industry Group for the retailers. But again, they make a small component of our business. And then in terms of rates and taxes on the next slide 29, we continue engaging via SAPOA and other industry bodies to get government to pay their portion of the rates and taxes, which is the norm in the property industry. I'm jumping to slide 30, where the following slides, 30, 31, and 32, just demonstrate the tenants that we've secured. And we show, again, that we've done a lot of work, and the majority of them have signed leases at well over 5-year terms with minimal reversions on that. And then on slide 33, we just name the tenants that we've renewed the leases, the likes of the SARS Belleville that I touched on earlier, your Shell House and your Servamus in Durban. I think Servamus at interim was one of the big 4 leases that was remaining, and we had indicated at interim that we were quite advanced. This is a police head office in Durban. We've signed up 13,500 square meters at a very good rental over 3-year terms. And that is what gives us more bullishness. If you look as well, the Department of Justice on the leases that we've renewed, they've really come to the party. They've renewed close to 20,000 square meters throughout the country. On slide 34, we just show the new leases, which is the SARS Randburg that I touched on earlier, and the Special Investigation Unit in Liberty Towers. We've taken that up. And then we just demonstrate that had it with the Capital Towers, which happened post-reporting, we have another 10,000 square meters there of new leases that we've signed up. And that education group at Delta House, should they come after COVID, when we get to level 1, we should be able to conclude a lease or a sale on that other one. I think the CEO touched on the tenant retention, that we've managed to keep well over 90% of our tenants. And then on the next slide, 36, we just show where the vacancies are. Again, you can see Capital Towers, but that's one that, with a lot of hard work, we managed to refill after about 8 months. The one that is a worry for us is obviously UNISA building in Johannesburg. I mean, that is at Gandhi Square. We lost UNISA, and we are trying to find a tenant. It's not a government node, as it were, because Johannesburg is predominantly provincial government. It's a vacancy that we are trying to make a plan, which the CEO will touch it on his conclusion. And then on the valuation, slide 37, I have touched on that, so I'm not going to repeat myself there. And then disposals are, on the next slide, 38, continue being a challenge. The Free State is one node that we've really added on, and we'll be doing a lot of work. We have appointed some brokers that really know the lay of the land, a chap called Vilko du Toit from National Real Estate, who was well plugged into the Free State system. We've given him a mandate to help us try and fill up the vacancies in Free State, or to try and help us to dispose to small BE companies in that area. The rest of the disposals are non-core. I think with the current economic climate, they remain a challenge. Having said that, we have some crown jewels where we've received unsolicited offers. Ordinarily, we wouldn't sell our crown jewels, but given the current economic climate, as a team, we are evaluating and looking at the benefit of getting in some cash to strengthen our balance sheet. That's something that we can share with some of you on the one-on-ones, some of the initiatives that we're looking at on there. And then I think with that, I would like to take you to page 40, which is just a tabular representation of the CAPEX program, and to report on the CAPEX projects that we're working on, It is Pointons, which is the building where we have 70,000 square meters with Department of Correctional Services and the Defence Force, where we are quite advanced in getting the lease agreements. We did a 32 million rand fire project on that building, which has stood us in good stead in terms of getting those 2 leases renewed. And then the Department of Justice is one of the leases that we've renewed. We've embarked on the capex there. Similarly, with the new lease with the SIU, they have moved into the building. And with that, I'd like to hand over back to the CEO.
Thanks, Otis. I think maybe just to quickly wrap up, I think you do have the presentation in front of you. I won't go on to page 44. I think we'll probably just deal with slide 43. I think COVID remains probably the unknown for most companies in South Africa and around the globe. And certainly we would like to believe that we've got adequate plans in place and to try and stem whatever unknowns that may come up from COVID. In chatting with senior government officials, there is an expectation that the number of infections will rise significantly, and obviously that will have a knock-on effect, in employment rates and obviously the balance sheet of private companies particularly. And I've already mentioned the sovereign already itself has committed pretty huge sums to try and restart the economy and issued some initiatives that obviously have impacted on the sovereign balance sheet as well. It is something that we do keep an eye on as a company, given that close to 80% of our income does come from sovereign. It's something that we do try and manage. Otis and Shanil have spoken about the relief efforts that we are engaged in with some of the tenants that we have earmarked as a potential risk, and we will be updating the market as we conclude on those. But as Shanil has said, they are really not significant, but we take every single rand very seriously, and we are pushing very hard that the leases are contractual, is our house view. And having said that, we obviously would like to try as much as possible to stem any losses from potential tenants that may have that may need to go into business rescue. The quality of earnings is very much important for us. I think as a management team, we are obviously focusing on CapEx is going to be a big issue for the next financial year. Having signed the bulk of the leases, we move to the next phase of the business. CapEx is going to be a big ticket item, making sure that we're getting value for money for the services that we basically going to be spending on these buildings, for which are contractual. The tenant installation allowances have already begun on some of the buildings, and it's something that we have a strategy on, and we are busy on taking 2 new staff members, particularly to look at the cost side, to make sure that in these particular times we get best value for money around that. What we have had to do, and it's a bit early, one of the lessons that certainly we've learned as a management team is that given our proximity to government, we tend to be probably far ahead of the market in terms of what is the thinking within government and what are some of the plans. And we tend to sometimes over-communicate that too early, which leads to protracted delays, i.e. as more engagements from government side takes place. And I mean, a case in point is the bulk leases. We first announced that in 2016 and only got concluded in 2019. I think our downfall there was certainly over-communicating that, certainly what we saw as a risk, and we did try a few initiatives at that particular point in time to try and correct what we were seeing from government. Having said that, I can tell our investors that we are involved in equally an exciting initiative with various government agencies to basically focus particularly on our vacancies. Having broken the back of our bulk leases, and that seems to be very much in control. And we're starting to see some green shoots there. As you can see, we have stemmed the tide on the whale, which was definitely going down. It's now basically facing up. Certainly myself and a few managers have now shifted focus, and we are now basically involved in a very, very high level strategic discussions with various government entities to make sure that we focus and stem the tide on our vacancies. I am aware that government has made some announcements, and I'm led to believe that around the 23rd of June there will be a major announcement from government themselves. At that point, we should be in a position to communicate a bit more detail to the market in terms of the initiatives. This is a strategic initiatives. It does mean a change of mindset from a fund perspective, from ourselves. We are integrally involved in those discussions. We think we have found a very, very amicable and very strategic and very long-term impact, positive impact for the business. And we are quite excited by those initiatives. But yet, again, having said, it's still too early to formally communicate to the market, given that the markets are very impatient. And as a shareholder, and shareholders are very impatient to see the share price recover. But certainly I can assure shareholders that those initiatives are well advanced, and we look forward to the formal announcements that government will be making around the 23rd. We have seen a couple of newspaper articles where they have alluded to some of the initiatives that they are undertaking. And as I've already said, we are very much part of those discussions, and we are part of the solution rather than the problems. And those are positive developments for Delta and people that have inner city buildings. And it's something that we're looking forward to concluding, and we will update the market in due course. As we improve our whale and with the latest initiatives, that will have a serious impact in terms of how we engage with our banking partners. It comes with a new mindset, and obviously our cost of debt should appropriately come down to comparable levels, which will allow us to achieve our targeted range of having 80% fixed, as Shanil already mentioned. And we will certainly be engaging on the one-on-ones. We will try and get approval to share some details with some key investors, because obviously this will have an impact on how they value their investment into Delta going forward. And unfortunately, we are under strict confidentialities at this particular point in time, but we will try and give some indication without giving the game away and taking the limelight away from the event that is planned by government in the next couple of weeks for the major announcement. With that, I would like to thank everybody that has dialed in, and we would look forward to hearing your questions if there's any. We are available, and we will basically obviously take further questions as we engage with you on the ones-on-ones as well.
Thank you very much, gentlemen. The first question we have is from Daniel King at Avior Capital Markets. He's asking three questions. How do you anticipate to fund the 600 million of defensive capital over the next 3 years, given the low interest cover ratio? The second question is, do we expect your portfolio fair value to increase by the 600 million rand after the required capex has been spent? And how will your cost of debt change this year if the repo rate stays at the current level?
I think maybe I will ask Shanil to take the first question, and then the first two questions, and then I will come down on the last question.
Thank you, Monet. So I think firstly, with regards to the capex, how we plan to fund that. If you look at the business, and I think as our shareholders are very much aware, there isn't any headroom on facilities. And Sandile may give a bit more content, in the absence of doing a proper capital raise for the business, I mean, the only other avenue that we do have is the working capital itself from the business. And with that being said, that is how we've actually forecasted to manage the 600 million spend. Obviously, if you look at the interest cover ratio, that's more a factor of finance costs and a factor of revenue. So, you know, if the capex is more a cash flow issue that will come out of working capital. It's obviously not ideal. We would like to have headroom in terms of facilities or fresh new capital as an example. But I think under the circumstances, this capex is defensive. So we're not expecting any significant accretion in value from spending these funds. And with that being said, I think that's how we plan to actually manage it.
Thanks. Thank you very much.
Okay.
Great. Thank you. There are no further questions on the line. Ladies and gentlemen, if you would like to ask a question, if you could please email us. But at this stage, there aren't any further questions on the online platform.
Well, okay, ladies and gentlemen, we will be available on the one-on-ones the whole of this week. We will be engaging further with shareholders, and we can hopefully give a lot more granularity should the shareholders have questions, or stakeholders for that matter, and including our banking partners. I think certainly, these have been extremely challenging times, and I think we are starting to see some positive shoots, as already mentioned, and we look forward to engaging with you on Roadshow going forward. Thank you.